Hey guys, it's Max. How's everyone doing? Let's talk options for a little bit. This is for the option bros out there. We're going to talk about a broken winged butterfly, and we're going to talk about the trade I showed you how to do yesterday, and we're just going to talk about options for a little bit. I felt like talking about options. Okay. Let's get into this one. Okay, too long don't read. That's the trade I'm going to teach you guys how to do. That's the profit and loss graph. It doesn't expire till the 3rd of January. We're doing this for a couple of reasons. I'm showing you because I want to show you how to do a broken wing butterfly. This is a great trade for a lot of situations. And it can either be a broken wing butterfly can either be bullish or bearish. You can put the risk to one side or the other. I tried to develop a level of synchronicity or convergence in my trades. The trade yesterday, and I didn't do this trade with real money. I'm just showing you guys how to do these. I didn't play this long call yesterday. Thank goodness, because it's down a little bit today. I may really do this broken wing butterfly though, but anyway, we're just going to pretend we had done this call yesterday in real life. Okay, so we have $100 on the line. We have $100. We're hoping for an outsized move up. We're hoping it gets to 610, and we might make $350 or something. Okay, and we have, what do we have? This expires on the 31st. Okay, so, but if it doesn't get there, what's going to happen? Wonder if it just kind of stays where it is. Okay, well, we're only losing $102 on this trade, so wonder if we can make $102 from another trade or more that makes money if it stays where it is, in case I'm wrong, in case we don't get the rally. But the important thing is, that trade can't cost us too much on the upside, because in case the market turns around and goes up, we don't want to mess this up. We still want our upside. We want some protection. So, or we want to do another trade. And I do trade like this all the time in real life. I'll make one trade, and then I'll make a trade on Monday that might be a long. Then on Tuesday, if we pull back, I might get long again. I might buy the dip. Then on Wednesday, so I have two trades on. I have a long for Monday, a long for Tuesday. Then on Wednesday, if we rally, I might sell Tuesday's long, and then I might put on a different trade, a broken wing butterfly or something. That's what I'm trying to show you guys how to do. It's more of a, I don't know if you would call it a campaign. Not really a campaign, but just I'm trying to teach you guys strategic option playing. Or I'm trying to teach you what I know about it. If you guys might know more than me. If you guys know something that I'm missing, put them in the comments, or I'll come watch your channel. I mean, I'm trying to learn constantly also. I think I know a little bit, a thing or two, but I'm always learning new stuff. So here's what I would do in a situation like this, or here's something you could do. All right, well, we're going to keep that trade open in one window. I always love to show you guys this trick. Hit duplicate. Okay, then in the other window, I'll just show you guys how to do it from scratch. I always just start with neutral, and it says long put butterfly and long call butterfly. A put butterfly is with 3 different put strikes. A call butterfly is with 3 different call strikes and call options. So we're in the indexes, right? Okay, and in the indexes, puts generally trade rich compared to calls, especially at the money now. Money put. So we're gonna do a put butterfly. I'll show you why. The main profit drive. Well, let me show you this first of all. Okay, first of all, a symmetrical put butterfly. It has you sell 2 options. You sell 2 puts in the middle, right at the money, and then you go up. In this case, it was 5 strikes out of the money, and you buy a put. In this case, it would be an in the money put because puts are backward anyway. But then you also go 5 strikes out of the money. That's why it's symmetrical. So you sell 2 in the middle, sell 2 puts right there. Then you buy 1 put there and buy 1 put there. So what's your net position? You're short 2 at 594. Then you're long 1 at 590, 599 and 589. So anyway, you're short 2 and long 2. Nothing's naked. All right, so look down here at this debit. It costs you $114 to put this trade on. What it does, it gives you a range where you could make money. I'm gonna change the expiration too. The other trade expired the 31st. We're gonna make this trade expire the 2nd. We're gonna go out 1 day beyond it. I might explain why I do that in another video, but anyway, okay. So back to the broken wing, or this is just a butterfly. This isn't broken wing. When you do that, that's when the wing's broken, when it's no longer symmetrical. Okay, so this is a non-directional trade. A butterfly is a non-directional trade. A broken wing butterfly, where you make one of the wings, they aren't equidistant anymore. You can either make this one, you can either drag that one up. This one, I mean, there's several ways you can do it, but let me just mess with it. Then I'm going to explain what I'm trying to do. Well, okay. I mean, I don't know if let me think about this. Okay, well, okay, so let's think about this trade. Let's think about this trade. Now look, so if the market goes down by the 31st, because that's when our other trade expires, it's going to be worthless. Or let's say the market stays here by the 31st. Well, actually, let's do it this way. Let's put it on the same expiration date. All right. The market stays here and doesn't go anywhere. We take this trade off for $179 winner. If the market crashes or goes down, we take it off for $130 winner. We just don't want the market to go up more than 0.5%. And if it does go up to say to 600, we lose 250, and if it goes to 605, we lose we lose 463. And then we lose 488 the rest of the way. So let's look at the other trade. The other trade, if it goes to 610, we make 400. So, well, if we put these two trades on, we could either make money if the market rallies and goes above 610, or if the market stays the same and does nothing. Because remember, on this losing trade, we're only going to lose $102, and it looks like we're potentially going to win more. So we could turn this $102 loser into a winner, to a potential winner. However, if the market rallied and went to 600, which it might, that's the first trade would lose 100. The second trade would lose at 605 would lose 400. So it's exposing yourself to about a $500 loss if the market moves up 1% before now and the end of the year. So I would not do this trade. That would be a bad thing. But that's my thought process. I'll look at a trade, and I can see if I'll try to find a trade and see if I can find a trade that complements the trade I already have on. So I thought this one might be a good one, but it's just too much loss right there. So let's do some financial engineering. Let's mess with the strikes a little bit. Let's see if we can find something that's more attractive or maybe less risky. I mean, I guess we could do this. We could do this. So if the market keeps dropping, okay. Right now, if the market keeps dropping, we lose $100. If we put on this broken wing butterfly and the market keeps dropping, we lose that $100 plus 900. So we lose $1,000. Now the market has to drop another 2.5% to lose $1,000. But even if it drops 1.5%, we're going to lose 500. But this would not mess up the rest of our trade, though. If the market turns around and rallies, if the market goes nowhere, this trade would be worth 200 or 300, anywhere. If it goes anywhere between down 0.5 point and up 1% or something, it's be worth about $100. Okay. Then if it blows that out on the upside, it blows out the 598 strike on the upside, that's fine too. At least it doesn't cost us anybody. It's a $36 winner plus whatever the other trade is. The other trade at 605 is a $400 winner. So that's 440 and it goes up from there. Something like that might be complimentary. That might be a complimentary trade. I don't really like the extra risk it's adding to the bottom. But I'm just trying to show you guys these for fun. Let's not do this one in real life, but just for illustration purposes, I want to see how these trades work together. So we're going to put this one on paper just for fun. All right, and this is the hedge to the long. Or it's not a hedge, it's the complementary. Okay, so now think about this. We can, let's say Monday, let's say we come in Monday and the market hasn't moved. Let's say there's Saturday, Sunday, Monday. Here's Monday morning here's Monday at 2. We come Monday at 2 and the market still hasn't moved. So that means this position's, we could cash it in up $150. And that's what we'll probably do. We probably, if we have a chance to cash it in Monday, we're going to take we probably won't take the 1 day risk at having the market go down. However, if the market goes down over the weekend, there's nothing we can do about that. And that would beat this trade. Then this trade would be about $1,000 loser between the two trades. This one would lose 900. The other one loses about 100. So we're going to paper trade this. We'll come back in on Monday. We'll see what's happening. Then maybe we'll try another complimentary trade. Maybe on Monday, how about this? Wonder if the market rallies the rest of the day for some reason, is up 1% and closes at 600 or something. So then we come in Monday and it opens at 602 or something. We're like, darn, we didn't even need that. You know, we shouldn't have even done this trade. We didn't know that at the time. What we can do at that point, next Monday, most likely, we could put on a third trade. Hang on. We could put on a third trade. Possibly. We'll have to see how expensive options are. On the 31st, we could put on a 1 day put trade, you know, and then so like I say, in my scenario, if the market rallies to 600, 605, Monday we open up there, we'll put on a 1 day put trade that will cover us. Then if we have a crash on that next 1 day, it won't mess up anything. We might put it on. We're going to see how much, but we have to see how much it subtracts for our winners. We'd probably put on something like this. Something like this. We'll take $100 out of the winning column. I mean, that's what it's going to have the effect to do, and buy $100 out of the money put on the 31st, or Monday would be the 30th, but we were buying on the 30th for the second. The market crash. That's the only thing that mess up that other trade is if the market crashes, you know, then this would save us. Let's say the market goes to 575 or something. That other trade's down 1,000, but this one's up 900. Let's say something really bad happens. You can see the other one's down 1,000, but this one's up 2,500. Let's say nothing happens. This one loses 100, but the other one is now making money off both of their trades. Both of their trades are now profitable. So anyway, we'll may look for a third trade on Monday. So for right now, let's go see all the trades I've shown you guys. This Russell trade's working out really nice. I'm going to talk about that in a second. But so these are convergent trades, or our synchronicity, or I don't know what to call this. But anyway, so we're down $81 in the long call. Call this a rescue trade, maybe. This broken wing butterfly is going to rescue us if the market stops and does not rally. We'll make a couple $100 on the broken wing butterfly for non-movement, and it will offset the $100 we lose on the other one. Okay, so now we're done talking about these two trades. Like I say, do not do them in real life. Plus, I don't know if anyone did the long call yesterday. Especially don't do this one if you don't have the long call on, because this trade by itself, this trade is meant to go with that one. Okay. All right. So I want to show you this. Next time we have an options class or sometime in the future, I'm going to show you this style of trading. I stole it from Petrocelli. I call it the loaded dice trade, but these trades, you have an obscene. This is a bullish play on the Russell for the end of the year. You have an obscene amount of buffer. Look, the Russell, even from here, would have to drop more than 1.8% to mess up the trade. Oh, but even if it drops 1%, the trade makes just as much as if the Russell goes up 1% or whatever. But the really good news about these types of trades is if there is some type of outlier move, you're along for the ride. The bad thing about these kinds of trades are if it passes your buffer, this trade had about $5,800 risk. These are big contracts, and I simulated this a while back. Let's see. Or actually, on the 23rd, right before Christmas, I was just thinking, what's the guy that if a guy wanted to play a rally into the end of the year? I do have something similar to that on in real life, but it's with the Qs. It's pretty much this trade. Yeah, this is the same thing. This trade cost about $1,400 risk, but you make $120 right away, and you get to keep the $120 if the market does anything other than drop 3.4%. And the bonus is if the market happens to go up more than 2.5% from here, you stand to make extra. These are great trades. I'll have some content on them soon, but I just wanted to show you that even on a really bad day, even on a bad day, these ones that sell puts to buy calls because they're also using time decay. That's the reason on a bad day they can be up, because they've sold something to finance the long. So, that one's up on a bad day, even though it's a bullish bet. This one's up on a bad day, which is one I just showed you. It's also a bullish loaded dice. And then also, I didn't make any content on it. But I just put this in to look at it myself. Here's another broken wing butterfly. This is a bullish broken wing butterfly. So the scenario to this trade, and I think I did this trade like before Christmas. Let's look. Yeah, it's long call butterfly. I think this is it. Well, I wanted to see what day I put it on. Well, anyway, look at this. This expires today. Okay, well, shoot. We need to look at this then. Okay, so when I did put this on, I was looking at a chart, and the all-time high was at 605, 607. I wanted to put on a trade that made money if we hit the all-time high by the end of the year. And I didn't make this, or I guess by Friday. So we didn't get there by Friday unless we rally. But if we would have, this is a way to target a strike. And I thought it was a strike. A price they could reasonably go for. Let's look back to the market. Okay, I could have sworn I put the gap box on there. All right, so let's go back to the option strat. This trade, I want to look at when it was put on. This is like the 10th time I've done this. Okay, so December 19th. Okay, December 19th, it was a long call. This was a broken wing butterfly. But this is the trade I just showed you, targeting 605 level. Not that one, this one. We didn't. All right, so I was going to show you guys. So the broken wing butterfly, we sold the 605. This was a call broken wing butterfly. We sold the 605 call, and then we went to 614. So that's 9 strikes up, and bought 1 call. So now we're short 1 because we're short 2, bought 1. But we don't want to be short any options because that has unlimited loss on the upside. So we don't want that to happen. But then once we own this call also, this deep in the money call at 590, then we have 2 longs, 2 shorts, and we're flat. Except between the we're flat as long as the market stays above 593. At that point, we expose ourselves to some loss. But this is a great trade. This would have been a great one to do in real life. Only had $300 risk. If it would have hit 605, which is reasonable, it could have. You could have easily made, even if you would have held till the very end, and even if it didn't go right to the middle, you could have easily made $500 on 384 if the market would have just rallied any. Even if it would have just gone to 597, you could have made some. Anyway, woulda, coulda, shoulda. Woulda, coulda, shoulda. So let me show you how this works. So we can also go to our positions. These are the actual trades. Okay, so when we sold this one, STO, sell to open, the one in the middle, the 605 call, we got 22 cents for it. So we sold it twice, so we got 44 cents for it. But then we had to buy two other calls. One cost $4 and one cost 5 cents. So we bring in 44 cents, but we spend more than $4. So the trade goes on for a debit. The debit's right there, 384. Usually I prefer credit trades, but broken wing butterflies are debit trades that can still work out, especially if you get a little move from the price of the stock. We were playing for a little move, not a huge move, because I think there was. Let's go look at this again. Long call, but I think it says it right there. Okay, long call butterfly, December 19th. So let's do this. That's in the SPY. Let's go see where the SPY was December 19th. It may have been higher. December 18th was the day it dropped. Big. 19th was the day it kind of stabilized. Okay, so at that time, market was at 587. I was looking at the chart. Remember, I couldn't see anything past here, but I was thinking, boy, my scenario is I wouldn't be surprised if they tried to take out an all-time high by the end of the year. All-time high is at 607. That's why I put it at 605, because they don't have a strike at 607. So that's how I chose to aim for that area. Anyway, we'll monitor these two trades we put on together, and we'll also see how much the broken wing butterfly cost us to take off at the end of the day. I mean, it's looking like we might be fine. It's up $35. If this was on in real life, I would just say take this off. Although I don't know, as soon as I took it off, if I did that, I'm going to show you what happened. As soon as I took it off for $32, I would do that just because I didn't want to lose money if the market sells off into the close. As soon as I did that, the market would rally 1.5% into the close, and then this thing would have been worth 800 or 900. I'm going to let this go to the end of the day, let the chips fall where they may. If the market drops and I lose 384, so be it. I think there's a pretty good chance the market might even go up a little bit more and make this more profitable. Anyway, all right, guys. Well, that's enough learning for today. Let me know if you have any questions, or just let me know what's going on. I'd like to know how you guys trade indexes. Do I have any index traders in here, or am I the only one that's obsessed with indexes? Here's my thing on an index. I have one thing that I've been studying since 1998 when it came out. It's called the SPY, and I've been studying the S&P ever since the 80s or whatever. So my one stock in my head never changes. A guy that's a stock guy in the 80s, he would have had to been an expert in IBM. In the 90s, he'd been an expert in some biotech stuff. In the late 90s, he'd been a .com guy. Nowadays, he's an AI guy. That's fine. I just like to focus my energy on one thing. And I think I know more about my one topic, the S&P, than most traders that trade single stocks know about their single stocks, just because I've been at it so long. So anyway, all right, guys, I appreciate it, and I will talk to you later.